All right, welcome to your DRS, your document review simulation. Now, with a DRS, it's basically like a TBS, except it has more exhibits. So in other words, you click on the tab that says exhibits, that will open up and it says exhibits or resources, support documentation. It could be a letter from the CEFO. It could be a working trial balance. It could be whatever we'll look at. It could be some financial statements. It could be ratios. So we're going to look at those exhibits to help us answer the questions. When we look at each item, there may be 3 to 7 choices. When you click on it, it comes back with a check mark. You can unmark it if you want and so forth. So the way we're going to choose between the 6 or 7 choices is by looking at the support documentation, the information in the background and so forth in order to work through it. In the very back of your book is a DRS appendix. Please look at that at some point. The benefit is it's us walking you through doing a problem like this, but actually working through the functionality of the software so you get some hands-on experience with how to do this at the actual exam. Because at the exam, you've got some whiteboards that you can write on that don't erase. You can write on both sides. You get 2 of them, and you can raise them up. They'll give you new ones. So instead of scratch paper, that's what you have. We always encourage people to go buy a whiteboard. Buy a little one so you can practice. It's erasable, though, so you don't have to spend a fortune. But get one so you can start practicing filling out mnemonics, memory aids. You know, we're learning all these great mnemonics and memory aids. I suggest that you start jotting those down. Get used to that kind of stuff, also working through any kind of problems as well. So in the very back, you'll see the functionality in the appendix of working through it. When you play with the IPQ Interactive Practice Questions software, that exactly mimics the exam. That gives you some hands-on experience as well. My goal in going through this is really to review the stuff that we just learned and talked about, as opposed to the functionality. But again, it's a good way to review the material and also make sure you're understanding it, and then you practice with the functionality. All right, starting out, it says here, there's Work tab, Exhibits, Help, and then you can split the screen vertically, horizontally, and so on. It says scroll down to complete all parts. Background. You are an experienced senior associate, congratulations on your promotion, of Shipley LLC, a large national auditing firm. You have just been assigned to the financial statement audit of Daly Company, called Daly, a non-issuer. Remember, non-issuer is non-public. So instead of PCAOB, peekaboo, we look at standards established by the AICPA, American Institute of Certified Pain in the Public Accountants. Non-issuer for the year ended X6. Although Daly is a new client for you, Shipley has been performing the audit for more than a decade. All right, so I'm a new senior. It's a new client to me, but the company that I work for has been doing this for many years, more than a decade. Company profile. Daly Company is a manufacturer of premium stuffed animals and other soft infant toys and has been in existence for nearly 35 years. Daly has a strong presence in the high-end infant and toy markets. One of Daly's signature competitive advantages is that their classically themed products all include handmade elements and are known to be high quality. Daly owns its own manufacturing facility located in Nebraska. Daly has historically experienced solid growth at times into the double digits, which has slowed in recent years. Company is divided into several divisions, which are aligned with its major product lines. In X4, Daly entered into a contract to produce stuffed animal versions of characters from Timmy Tiger. Oh, that's one of my favorite shows. A popular young child's television show. Marketing. Daly operates in a highly competitive industry which has experienced increased competition from newer companies that are able to mass produce less expensive, more trendy products. The company's distribution channel consists of high-end boutiques and toy stores. Daly has resisted the trend to sell through big box stores, Costco, right? Gotta love their $1.50 hot dogs, or through large online retailers. So they don't go through eBay or Amazon or something like that. Its products are only sold and shipped in the lower 48 states of the USA. Consistent with industry practice, Daly follows a policy of FOB destination. Remember FOB shipping point, FOB destination? So here is the seller and here is the buyer, boom, boom, right? This is the seller. And FOB shipping point means that when it is placed with the shipper, that's when title and risk transfer. Here, they follow a policy of FOB destination, which means boom, that's when it trades. So what it says here is Daly follows a policy of FOB destination, free on board destination. So it's free on board until it gets there. That's when the sale is recorded. Management. The company is a family-run partnership with 2 generations of the Washington family currently involved in operations. There is a 5-member audit committee, which is comprised of both family members and business associates of the partners. There is also a 7-member board of directors, which is comprised of family members with a partnership interest in the company, but who are not involved in the day-to-day operations of Daly. All right. Doesn't sound very objective or unbiased. President and CEO Thomas Washington is one of the founding partners. He has been a successful businessman throughout his career. However, he has recently been butting heads with his son, Mark Washington, who was recently named Executive VP of the company. The two have differing visions for the future of the company and differing ideas about how to remain competitive, right? It's the old generation versus the new generation. The CFO, Mary Ann Washington Sparks, can we have more names? Has held the role for 3 years. Both Mark and Mary Ann have grown up in the company by working as a stream of increasingly responsible roles. The Vice President of Marketing, Henry Washington, is Thomas's brother. Henry's son, Fred, also works in the finance department as controller, but does not get along well with Mary Ann and frequently complains about his compensation and about being passed over for the role of CFO. Right? This sounds like a whole family drama. They need to be on a daytime talk show. Right? Nobody listens to me. Engagement. The previous senior associate on the engagement, George Smith, participated in the audit of Daly Company for the past 3 years. George began work on this year's interim controls, update, and audit planning. However, due to medical problems, George was neither able to complete his work nor finish reviewing the work of his staff and is now on an extended medical leave. He's on a leaf. He's on a leave. Yes, he's floating on a leaf. He's a bug. Daly has provided you with its draft balance sheet and income statements. You must review the prior, so those are going to be the exhibits. You must review the prior year audit program and work papers. So we're going to look at the program from last year, work papers, the interim work performed, and the client's draft financial statements in order to prepare the audit program for X6. So they're asking us to do the audit program for this year based on last year's audit program, financial statements, a balance sheet, an income statement, and some work papers. Review the prior year audit program. Based on the review of the prior year's audit program, draft the financial statements and the interim field work. Updated memo, analyze each step of the asset section of the proposed X6 audit program, revise the proposed X6 audit program, correcting any errors, adding any necessary steps, or removing any inappropriate or unnecessary items. Ensure that the X6 audit program is appropriate given the information provided. To revise the proposed X6 audit program, click on each segment of underlined text below and select the needed correction, if any, from the list provided. If the underlined text is already correct in the context of the document, select original text. If removal is needed from the underlined text, then hit delete text. You'll see this throughout, and you'll see this on all the parts of the exam. It'll say original text, which means the way the question's set up, keep it. It'll say delete it, which basically is saying that you need to remove it because it doesn't relate to this question in a sense. Maybe there's, accounts receivable or this, they have no accounts receivable, delete it. Or you'll pick one of the other choices. If a procedure is required other than the one indicated in the original text, the appropriate procedure should be selected from the remaining items in the list. Okay, so that makes sense. All right, it says here, proposed audit program. This is the one that the assistant wrote up. It says accounts receivable, obtain a schedule summary of all accounts receivable accounts, agree each account balance to the trial balance, tie the schedule total to financial statements, maybe. Confirm balances over $79,000, investigate any discrepancies, examine allowance for doubtful accounts, that's your bad debt expense, for preciseness and consistency with company policy. Well, what kind of, are we looking for absolute assurance? What did we learn? Reasonable, based on cost benefits. So we never want to be precise, we want to be reasonable. Trace receivables greater than materiality threshold to subsequent cash collections in X6. What year are we in? We're going into X7, so subsequent cash receipts wouldn't be in the same year. It would be subsequent to the year that we're auditing, which means the stuff that comes in next year, right? So we should go to X7 and look back to see if we got it. Vouch 1 receivable to original sales transaction documents, investigating discrepancies. I'm going to vouch 1. How about many? Inquire about discounting and factoring. Okay, so that's if I have receivables and I need money. What can I do? I can pledge them as collateral for a loan. I can sell them, factoring. I can discount. I can assign them. So we'll talk about those later, pledging. Review cutoff of sales, sales returns, and cash receipts. So cutoff is periodicity, proper year, and no other audit procedures are required. Now, this question's a little difficult. I mean, I want you to realize we haven't covered a lot of stuff yet, right? We're one section in. This deals with audit procedures, audit program. We're going to talk in more detail about how to write an audit program and the step-by-step procedures and so on. That's going to be more in our substantive testing section, somewhere in like section 4 or so. But we're going to talk about that later. But this is a good kind of way to kind of get started to see what's needed, what isn't. Notes receivable. So that's a non-current, right? Note receivable long-term. We could have short-term notes receivable, but generally long-term. Obtain a summary schedule of all notes receivable accounts. Agree each account balance to the trial balance. Tie the schedule total to the financial statements. Confirm interim balances. Investigate any discrepancies. We're not going to necessarily look at interim. We're going to look at year-end, because the year-end is the financial statements. We're trying to look at their balance sheet, their income statement. What is it as of December 31st, for example? Inquire about discounting and factoring, maybe. Trace notes receivable greater than or equal to 79.2, okay, to subsequent cash receipts in X6, probably X7. Examine allowance for doubtful accounts for preciseness. There's that word. We don't have to be precise, not absolute, but reasonable assurance, cost benefit. Inquire about new loan agreements. All right, well, we want to look at loans. I'm not just going to ask you, I'm going to vouch, trace. I'm going to look at them. I need to see the paperwork to see what the terms and conditions are, what the interest is, when they're due, so I can set it all up. So we have a receivable. If it's interest bearing, I want to make sure we're receiving the proper amount of interest. I want to make sure that we have a note receivable. We loaned money to somebody. I want to make sure it was authorized. It was approved by the proper people, the board of directors, which is all family anyway. And then no other audit procedures required. All right, let's turn. It says, items for analysis, accounts receivable, and they're asking us to go through and do some stuff. All right, let's review quickly, because I don't remember accounts receivable. That was in FAR. Far, a long, long way to run. Woo, woo, do, 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 do. All right, anyway, I won't scare you with my singing. Accounts receivable. Now, an account receivable is a receivable that occurs in the normal course of business, right? Because I sell goods, that's an account receivable. A note receivable is not from sale of goods. That might be loaning somebody money, right? Selling something on a long-term receivable that's not in the ordinary course of business, for example. All right, so normally what do? We're going to debit cash for the cash we collected, debit accounts receivable, and credit sales revenue. All right, we'll be going over all of these in FAR, but some of you may not be taking FAR for a while, or maybe you passed FAR and you don't remember the stuff from financial accounting reporting, so I'm reviewing. All right, then we're going to set up our bad debt expense, because all of these receivables may not be collected, right? Some of these people are bad people. So what we're going to do is set up our bad debt expense. So to set it up, basically I'm going to debit an account called bad debt expense, and I'm going to credit allowance for doubtful accounts. So your allowance for doubtful accounts, your allowance for uncollectibles. Basically, this bad debt expense goes where? That goes to your income statement. Allowance for doubtful accounts is a balance sheet, a contra to the receivable. So when we want to keep our receivables at their net realizable value, the amount we expect to receive within 1 year, the accounting cycle, whichever is shorter, we're going to say this is face, this is my NRV, net realizable value, the amount that I expect to receive. Then someone's going to call you and go, hey, Raj, hey, how you doing? Great. Listen, I'm never going to pay you, ever. Have a lovely day. Bye. So at that point, I'm going to write it off. So to write it off, what I need to do is basically I need to get rid of the receivable and take it out of the allowance. So let's close out the allowance for doubtful accounts and let's take it out of accounts receivable. So what I'm saying is, wow, I'm guesstimating that whatever, 3%. And you can do this based on percentage of credit sales or aging of AR. So you can age your accounts receivable to come up with how much you think it should be in the allowance account. Or as you make a sale, you say generally 5% of my sales are uncollectible. I'm going to set this up for 5%. And then I go, whoop, there we go. There's part of that 5%. But then they're going to say, I decided to pay you. I go, what? And they go, you know, Raj, I went to therapy and I talked about it and I realized, you know, it's just not fair not to pay you when I promised to pay you. We call that a recovery. Right? So they recovered from therapy. So there's two ways to look at this. First of all, you can set this back up by debiting AR and crediting allowance. Then you're going to debit the cash and credit the AR. Now notice these cross cancel, so really the net effect is you're going to debit cash and credit allowance. What does that mean? What it means is we set it up for 5%. We go, oh, you're never going to pay us. We wrote it off, let's say 1%. Then we go, oh, we collected it. So what we do is we collected the money. So what we're going to do is basically, we already credited AR, we'll just leave it, debit cash, but we're going to set back up the allowance because we said we thought it was 5%. We figured this one was one of the 5. Guess what? It wasn't because they paid us. Add it back to the 5, so that's still a 5% estimate allowance. So again, receivables, set up the record the sale, debit receivable, then we set up bad debt expense, matching, conservatism. You want to match it at the point of sale. It's conservative. You don't want to overstate receivables when you think you're going to get less. Then you write it off, you recover it, set it back up, collect the cash, or you can just do this net journal entry. All right, bearing that in mind, let's read. It says, obtain a summary schedule of all accounts receivable accounts, agree each account balance to the trial balance, tie the schedule total to the financial statements. All right, so that doesn't sound bad, right? That's the original, sounds pretty good. Next one, delete? No, because we do want to look at the summary schedule of receivables. Obtain a summary schedule of all account receivable accounts, tie the schedule total to the financial statements. That sounds good, but it's even less than the previous one. Obtain a schedule, agree each account. Obtain a schedule of accounts receivable, agree each account to the trial balance. Foot, recalculate. Footing is adding, right? Foot and cross, it's like religious, yes. No, you're footing and cross-footing, you're adding together. Like I used to do that on my little 10 key. You're footing, adding. So foot, recalculate all manual totals. Well, we don't want just the manual totals, we want all the totals on the summary schedule. Test foot spreadsheets, tie the schedule, okay, that sounds good, except for the manual. Obtain a schedule summary of all account receivable accounts, agree each account balance to the trial balance, foot, recalculate all totals on the summary schedule, yes, and then tie the schedule to the financial statements. That sounds good. Okay, the next one, confirm balances greater than 79.2. I have no idea, right? I need to see. So let's see what we've got. We've got question 1, we did. 2, 3, 4, 5, 6, 7, 8, 9, 10, 13. I got a lot of questions. Oh, let's go to the exhibits. Now I got to look at these exhibits and see what's going on. It says, exhibit. Intro. Now remember, that's why I want you to practice with the software, because when you click on it, then each exhibit opens up. You'll have little things you can click on to open them. You can split screen vertically, horizontal, so you could have an exhibit here and the financial statement here, the exhibit here, the question here. You can unsplit whatever you need. Interim update memo. It says, Jack Lincoln, engagement partner, George Smith, senior associate, Dally Company. It says, date December 15th. Risk assessments for Dally Company have historically been set low. So risk is low for the revenue cycle. All right, now we're going to learn this, so I don't want you to freak out. This is a good introduction to everything, but we're going to learn about the different cycles, the revenue cycle, the expenditure cycle, and so on. So the revenue cycle is when we take the company, which we'll do this when we talk about internal control, and we break it down into different cycles. And the cycles make up, in this case, the revenue cycle would be sales, accounts receivable, and cash collections. Cash receipts. Cash has a lot of inherent risk. You need a lot of key controls over cash. So we're going to learn about the different risks. We're going to learn about the controls, audit risk. Audit risk equals IR times CR times DR, which we talked about. Cash has a lot of inherent risk. You need a lot of key controls. Notice they're asking us to write an audit program for accounts receivable. That's part of the revenue cycle. They're saying typically in the revenue cycle, risk has been low. So the risk has been pretty low. That's good. That must mean we have great internal controls. Let's check it out. It says here, risk assessment for Dally has historically been set at a low for revenue cycle. There have been no modifications to the controls during the year. During tests of controls, which we'll learn about, TFC, we noted 6 instances out of 10 where there were errors when we vouched amounts to the subsidiary in the subsidiary to the original sales documents. We noted that revenue was consistently recorded FOB shipping point. Wait a sec. Revenue was supposed to be FOB what? FOB destination means it's not a sale till it gets there. What we're doing is recording it here when it's shipped. So when it's placed with the common carrier, we're debiting receivable and crediting sales revenue. No, 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 no. It's not supposed to be considered a sale until it's received by the buyer. That's FOB shipping point. I'm sorry, FOB destination. So it said in the background, if I recall correctly, on the first page it said, under marketing, it said 48 states, daily follows a policy of FOB destination, but here they're doing shipping point, so that's a problem already. Also, we have 6 errors out of 10. 6 out of 10? Oh my gosh, that's 60% error rate. That is huge, right? 6 out of 10 are wrong. What does that mean about these statements? Are these presented fairly? I don't think so. Can you rely on this? I don't think so, right? So that is at not necessarily a whole financial statement level, but at an assertion level, for accounts receivable, these receivables don't look like they're going to be presented fairly in all material respects if we're looking at that kind of error. Now they used a word called vouching. Vouching. We're going to learn 2 words, vouching and tracing. Tracing and vouching. Now, tracing is where you go from the books to the source. Vouching is where you vouch it back. So what we're doing is we are tracing and vouching, vouching and tracing, and these are different ways of kind of looking at items, and what you're doing is you're going with the flow. So what we mean by going with the flow is we're starting and we're saying, okay, here's a source document. What I want to do is I want to take that source document and I want to trace from the source into the books and records. So tracing would be from the source into the books and records. Now, that says, here's this transaction. I'm going to trace it from the source into the books and records. This transaction that started here, is this transaction complete? So that's completeness. Vouching is the opposite. That says, let's go from the books back to the source. So in my books, let's say, in my financial statements, I see this account receivable in the books. Let's go back to the source, which is where the transaction started from. That tells me that this item that is in the books and records, this item here, this receivable, this actually exists, or the sale that created it actually occurred. So you'll see here that with vouching, we're looking at existence or occurrence, whereas tracing, we're looking at completeness. So here is the transaction from the source, which is the sale, the purchase order, so someone orders some goods, we have a purchase order, and then we go ahead and ship the goods and so forth. So we want to make sure that someone ordered it, flowed all the way through, they shipped the goods, they received the goods, it's a valid receivable. That says that the transaction was complete. That's tracing it into the books and records. Vouching says we start with the receivable, let's vouch it back to where it occurred, that this sale actually exists, or the sale actually occurred, existence or occurrence. So that's what they're saying with tracing and vouching. So that's what we're looking at as far as tracing and vouching. All right, so in looking at this, it says here, reading on, vouched amounts in the subsidiary to the original sales documents. So they're vouching it from the books back to the source. We noted that revenue is consistently okay, so that sounds like a problem. 2, risk assessments for daily company have historically been set low for purchasing. So these have been low for the revenue cycle, It sounds like that maybe we need to reassess them at medium or high, because the risk should be higher if 6 out of 10 or 60% of these didn't tie correctly. So when we vouched them back, we tried to go back to the books and records. We went from the books back to the source. There was a problem with that. Reading on, risk assessment for daily company has historically been set low for the purchasing cycle. Now, the purchasing cycle is where we purchase stuff, right? So, for example, over here, the purchasing cycle or spending is where we're making a purchase. We have to pay for that. That's a cash disbursement. Cash, cash, cash. A lot of what? A lot of inherent risk. You need a lot of key controls. So that's where you're purchasing or spending. It says purchasing, there have been historically low. There have been no modifications to the controls during the year. No exceptions were noted during tests. So it sounds like everything was pretty good. It sounds like our risk should be low. 3, consistent with the audits of last 5 years, we recommend setting materially at 5% of net income or 79.2. 5% of net income. So we're going to set materiality at 5% of net income. So let's see what net income is, or they're saying 79.2. Reading on. During our interviews with finance department staff, several of them mentioned the increasing amount of disagreement between the controller and the CFO. The number of arguments seemed to have increased from the prior year. I forgot, were they married? That would explain the arguments. So there's disagreements. That could be a problem. Maybe they're disagreeing about from the financial statement effect or from the individual assertion effect. 5. We met with senior management, CEOs, executive VP, CFO. It was noted that both net sales and net income amounts were significantly lower than budgeted for from the first 10 months of the year. So net income, net sales, and net income were lower. The CEO stated this is due to the company's new ventures such as Timmy Tiger product line. The executive VP stated that the disappointing results were due to closing of several high-end brick and mortar stores, which were major customers for Daily. All right, next thing, minutes. It says, agenda, approval of Thomas Washington recommendation to immediately cease production of the Timmy Tiger products. Mark Washington recommended against this action. So they say, this thing's costing us money, we're losing money because of it, let's cease operations there. The next one, approval of interest-free open-ended loan of $225 to Marianne Washington Sparks. She's the CFO. They're going to loan her $225. Third one, approval of agreement to settlement and harassment suit against Henry. So someone's suing Henry. Maybe he's got roving hands. Henry, roving hands, settlement, we'll see. What happened? Agenda 1, not approved. So they're not going to cease operations for Timmy Tiger. Number 2, not approved. They're not going to loan her $225,000. Number 3, approved, which means we're going to settle the harassment lawsuit and move on. Very good. All right, let's move on. Here it says income statement. Here's our income statement for the year ended, X6, X5. Net sales, net of returns and allowances, went from $4,760,000 down to $2,850,000. Sales have dropped by 40%. That's huge. That is a problem. We'll have to look into that. Cost of goods sold dropped by 10%. Does that make sense? That sales drops by 40, but cost of goods sold barely changed? I don't know. We'll have to investigate. Net sales, compensation expense, legal expense went up from $47 to $250. So we're going to have to find out, wow, what happened? It was probably good that we settled with that lawsuit. Utilities expense, not a big change. Lease expense, no. Depreciation went way down. I don't know why. We'll have to see. Other expenses, fine. Net operating revenue, huge change. Part of that's cost of goods sold didn't drop. We have gain on sale, $400,000. Gain on sale of what? We have income taxes, $228, and net revenue of $208. Now, remember we said materiality should be about 5%. So we said that it should be about 5% of the amount. Well, how much are the sales? Well, if you look at this, you'll see here that 5% of 1,584,700 is that number they gave you, which was what, 70, they mentioned 79.2. That's great for last year. But this year, what happened? This year, basically 5% of revenue dropped, and it dropped from 1,584,000 to 208,570. 5%, that's like half of 20,000. That's like 10,000 for whatever half of 570 is. That's 250, 280 something. Let me just see. I'll cheat a little bit. What is it? 10,428. Wow. So materiality was 79.2 for the statements. Now they're 10,480 based on what's happened here as far as the decrease in our numbers. So you can see that on the income statement. Look on balance sheet. 06, 05, balance sheet. Cash, not too big change. Accounts receivable went from 290 to 540. That is an 86% increase. So if accounts receivable went way up, that means receivables went up, which means what's happening? That we've got a lot of bad debt expense, right? So accounts receivable is going up. Our allowance for doubtful accounts didn't go up by much. I mean, it did go from 5,000 to 10,000. That's at double. But notice receivables went way up. Receivables went way up. That means that we're selling stuff that we're getting desperate and selling it to people that have bad credit, right? Or we're just not following up on the policy of collecting. Allowance doubled. Prepaid expenses, a little bit of an increase. Inventory. Now, inventory went from 2 million to 3 million 1. That's telling you that your inventory is not selling. That's a problem. It tells us inventory went up. Maybe it's obsolete. Maybe we're selling stuff that nobody wants. That's a problem. We've got notes receivable. Now, this is tricky. Notes receivable went from 250 up to 475. That's a 225,000. Does that sound familiar? Didn't we not approve the loan? But it looks like we booked a loan. That's not good. That shouldn't be happening. If the board said no on the loan to the CFO, it shouldn't be in the books. Total assets, total current assets. Building, so we have no building anymore. We'll have to see. Cumulative depreciation didn't change. Why? We stopped depreciating stuff. We only had one building. It's gone. Furniture and fixtures changed a little bit. Accumulated depreciation for that. Long-term assets, total assets. Accounts payable went up. Current portion of long-term debt, no change. Didn't we pay it if it's current? Right? If it's current portion, it should be paid off. Taxes payable, accrued expenses, accrued vacation, boom. Notes payable went down, so I assume we used some cash if it was authorized, approved by the board. Common stock, no change. Retained earnings, dividends paid, and total equity. All right, so that's just skimming through. Next one, prior year, here's the last year's audit program. So it says accounts receivable, obtain a summary schedule, confirm balances, examine allowance. Basically, this is what they took and they're putting up as this year's schedule. So now let's look through the detail and see if we can start answering some of this. Number 2, confirm balances greater than equal to, or greater than 79,200. Investigate any discrepancies. Well, 79.2, no, that's based on last year's sales. So original text, confirm balances. Also, that is looking at the statements as a whole. They're asking about accounts receivable. Accounts receivable are individual receivable balances. That's way too large a materiality. We may say for this accounts receivable, materiality is 10 grand, but we may say for the statements taken as a whole, materiality is 150 grand. So in that case, too big. Delete. No. Confirm all balances, investigate any discrepancies. We don't need absolute assurance. What do we need? Reasonable. Confirm balances for all receivables. Confirm 100% of individual material receivables and a sample of the remaining. Maybe. Confirm 100% of material receivables and a sample of the remaining. And investigate discrepancies. Yes. Because that'll tell us about the receivables, whether or not they exist. It'll tell us about whose name they're in, the rights, right? It's in my company's name. There are receivables. Next one, examine allowance for doubtful accounts for preciseness, not preciseness. Original, preciseness, that's absolute assurance. Delete it, no. Examine allowance for doubtful accounts for preciseness, no. Examine allowance for doubtful accounts for reasonableness and consistency with company policies. Recalculate the allowance for doubtful account to ensure that the company policy is being followed. Yes, that's important for internal controls. Investigate and document any digressions from policy. Examine the aging of receivables to determine the adequacy. That sounds pretty good. The next one is preciseness. No. Last one is similar, but it's missing a few of those steps. That sounds like the best one. The 3 from the last. Next item, trace receivables greater than materiality threshold to subsequent cash collections in X6. So we have receivables as of X6. I want to trace them to the subsequent cash receipts in X7. If you owe me money December 31st X6, you're not going to pay me till January, for example. So let's trace it to there to say, yes, the cash was collected. If the cash was collected in January, February, it was probably a valid receivable as of December. So original text, no. Delete, no. Trace receivables greater than materiality threshold to subsequent cash collections in X5. Trace it X5 and X6. Trace receivables and collections X6, X7. No. Trace receivables greater than materiality threshold to subsequent cash collections in X7. True, right? That tells us about allocation, valuation, that the numbers are accurate in the financial statements. We'll learn about those assertions more in internal control and substantive testing. Vouch one receivable to original sales transactions, documents, investigate any differences. Now, if we're going to vouch, right, we're vouching. With vouching, we're going from the source into the books and records. Basically, I want to make sure the transaction started here and it was completed. I'm going to vouch not one, I'm going to vouch many. I'm going to vouch material ones, I'm going to vouch the new ones. I want to make sure they were done correctly. It says, vouch one, no. Delete, no. Vouch all, we don't need all. Vouch new receivables to original sales transactions, yes, because we don't need all of them because a lot of them we may have already done. Right, some we may have looked at. Let's look at the new ones. Vouch all prior years, no. So we want to look at that to see, do they exist and whose name are they in? Are they in the company's name? Yes. Next one, number 6, inquire about discounting and factoring of balances. So what we're looking at here is factoring and discounting of balances. Now, discounting is where I have a receivable, and it's usually for an interest-bearing receivable. I may discount it, kind of selling it or getting money on it. That's a discount transaction. Factoring, it was where you factor either with or without recourse. You can factor, it's a sale with recourse, meaning I sell it to you, but if you can't collect it, come back to me. Or I factor without recourse. It's an outright sale, it's your risk. Obviously, I'd rather have an outright sale without recourse, but they're going to give me 60 cents on the dollar. If I do factoring with recourse, maybe they'll give me 97 cents on the dollar, and that 3% is the amount they're charging me. So discounting, factoring, those are good. Inquire about pledging and factoring. What is pledging? Pledging is where you take your receivable, you pledge it as collateral for a loan. Maybe you assign it, transfer it. Oh, that would be good too. So I kind of like pledging. I also like factoring. I also like discounting. Inquire about pledging and discounting. Inquire about pledging, discounting, and factoring. Yes. Inquire about pledging, discounting, factoring, and confirming. Well, the confirming is what we do, right? The auditor sends out account receivable confirmations, which we'll learn about in substantive testing later down the road in like section 4 down there or somewhere around there. But what we're doing is we have positive confirmations, negative confirmations, blank confirmations. We send it out saying, according to our records, you owe my client this much money. Tell me if it's correct or you agree or disagree. And we expect something back on a positive confirmation. Negative says, according to our records, you owe this. If it's right, ignore it. Blank says, according to our records, you owe them money. Fill in the blank. If you don't get a response, you come back to them. So in a positive, you expect a response. If you don't get one, you send out a second. And we'll learn those steps down the road. The point is that we're going to do the confirmations. Best is inquire about pledging, discounting, factoring. Review cutoff of sales, sales returns, and cash receipts. So we want to do cutoff. Cutoff testing is like periodicity, right? Remember the FOB shipping and destination? Remember how it's supposed to be one, but they're doing the other? Their cutoff is messed up. So we've got to test the cutoff testing because we want to make sure that at 12/31, this number is correct. Now, at 12/31, remember, you're going to have stuff in transit, goods in transit. And is it FOB shipping point, FOB destination? If it's FOB shipping point, it's a sale when it is placed with the carrier shipped. If it's FOB destination, that's not recorded as a sale till it reaches the destination. So the question is, where was this stuff at December 31st? Let's do cutoff testing. Original, review cutoff of sales, sales returns, cash receipts. Yes. Delete, no. Review cutoff of sales and cash receipts. What about sales returns? Sales returns. What about cash receipts? Best one or most complete is the first one, original text. Next one, no other audit procedures are required. Well, we should probably do something. Let's see. It says choose an option. No other audit procedures required. It says reperform calculations to evaluate reasonableness of balances and accounts receivable and allowance for doubtful accounts. Perform analytical procedures on accounts receivable and allowance for doubtful accounts to evaluate reasonableness. Analytical procedures are the study of data, comparisons, and relationships. This is called ratio analysis, which we're going to learn about. Talks about all the things are complete, all the things are the proper amount. We might be doing like an A over turnover ratio or accounts receivable, number of days sales in average sales. So there's different things that we can do. The number of days sales in average receivables, that's going to tell us the number of days it takes to collect a receivable. So we can do some kind of ratio analysis. I like that one a lot. Let's talk about notes receivable. It says obtain a summary schedule of all notes. Agree that yes, we like that. So obtain a summary schedule of all notes. Yes. Obtain a summary of all notes accounts. Tie it to there. Obtain a schedule of all notes accounts. Agree with the account balance. Obtain a summary of all notes and then foot or recalculate all manual totals. No, we want all. Last one looks the best. Obtain a summary schedule of all notes receivable. Agree each account balance to the trial balance. Foot all totals to the summary schedule. Tie the schedule in. Very similar to the receivable one that we looked at. Confirm interim balances. Now remember, notes receivable, those are amounts that we expect to receive over time, and maybe it's not in the normal course of business like an account receivable. It says, confirm interim balances. Well, we're looking at year-end numbers. So let's see. Original text, confirm interim, delete it, confirm year-end balances, true, investigate any discrepancies, confirm interim payments, confirm year-end payments, confirm year-end transactions. We want to confirm the balance, not the transaction, not the payments. We want the ending balance. Confirm year-end balance, not interim. Next one, inquire about discounting and factoring. We like that. But as we learned earlier, how about discounting, pledging, and factoring? I like all three of those. Trace notes receivable greater than 79.2 to subsequent cash collections. Now we said that we want to look at 5%, and that's 5% of sales. So with 5% of total sales, that's where we came up with that amount of 10,600 or 10,428, something like that. It says original text 79.2, no. Trace notes receivable greater than 79.2, 10,006. Trace notes receivable 10,006 to subsequent cash collections, yes. When? The next year. So we want to look at the next year, which is 20X7. So we want to look at 20X7. Examine allowance for doubtful accounts. Preciseness, again, that's the word we don't look at. Let's see, examine allowance for doubtful accounts for reasonableness, consistency with company policy, recalculate the allowance for doubtful accounts. So that looks best. The others are preciseness. Inquire about new loan agreements. Again, I don't want to just ask about them. I want to look at them. I want to audit them. So original text, inquire, delete, review new loan agreements, yes. Vouch them, trace them, agree new loan agreements on the balance sheet. So we're going to vouch or trace the numbers themselves to the balance sheet, but we're going to look at the loan agreements, but let's review the loan agreement, look at the detail, see what the amounts are, then we'll tie the amounts to the trial balance, but not necessarily the loan agreement itself. All right, one more. No other audit procedures. Let's see, no other procedures. Inquire of management about loans to management and other related parties. Yes, because remember that $225,000 loan. Inquire of management about loans to management, yes, and other related parties, especially those that have unique terms. Determine the business purpose of the transaction and verify that it has been approved by the board of directors. Evaluate whether any, yes, so if you read through them, the one that's really important is approved by the board of directors. Loans to management are important because that's where we're looking in that $225,000 loan. That's why the third one is the most complete of all these as you read through them, because you're going to see what's happening. We're looking at a related party transaction where they're loaning money to one of the officers of the company. That's what we're concerned with. Now, there's a lot of meat here. This is an overview. This is a good way to kind of look through it and practice, and it talks a little bit about audit reports about audit programs, which we haven't talked about how to learn how to write these yet, but it's important that once we talk about it as we do, it'll start to make a little bit more sense, and that's where we apply the information. But it's a good overview to kind of introduce a little bit about risk, talking about accounts receivable versus note receivable, and the different steps that we're going to perform. Also, very important, read every answer. We put a lot of meat in the solutions. For the multiple choice, we tell you not only why one is right, but why the others are wrong. In the TBS and the DRS, read every solution. That's how you're going to learn. All right? Keep up the good work. Study hard.